Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Equity markets in the Asia Pacific are trading mixed today. After a down day in the States, we had JP Morgan leading a slide among bank stocks. That was after reporting disappointing revenue from both underwriting and advising on mergers. And the latest reading on U.S. retail inflation was a bit cooler than forecast, although money markets are continuing to project the next rate cut from the Fed mid-2026. And we are waiting for a possible ruling on Wednesday from the U.S. Supreme Court when it comes to President Trump's global tariffs, those that were announced back in April of last year. Joining me now for a look at some of these issues, Bloomberg's Abhishek Vishnoi. Abhishek joins from our studios in Singapore. Thank you so much for being here. Happy New Year to you. Can we talk about Japan first, because that's where the big move is happening today? What's driving the price action?
Hi, Doug. Yeah, happy to be here. Happy New Year. Japan is actually leading the gainers today, and that's largely because yen has become weaker, probably looking at a handle of 160 versus the US dollar. Why not? Prime Minister Takaichi is expected to announce a snap election as per one of the most prominent news wires in Japan. And it's set to be announced today. That has been the initial driver. Then we also have a hawkish Fed stance and Iran-fueled increase in oil prices that is threatening the Japanese currency. So there is a bit of a triple whammy going on there. The outlook looks pretty good and solid for stocks, but yeah, currency is expected to weaken. And it's not like an outlier. If you look at what's happening with other Asian currencies recently, they have also been weakening, while equity markets or local equity markets tied to them have been doing well. So, yes, yen's overnight retreat is helping Japanese stocks, and given the focus on fiscal spending, given the focus on corporate reforms, it looks like a good story for this year too.
So we're just beginning 2026. When you're having conversations with market participants, what are they saying about the year ahead for Asian equities?
Well, if you look and talk about Asian equities, it does look like a lot has happened so far. How it happened in 2025. There is optimism around China. There is optimism around Japan. A lot of optimism around Korea, Taiwan, and that's getting reflected in the stock price as well. I think if you look at the YTD performance, these markets are doing pretty well, leading with Korea and then Taiwanese benchmark, then Japan, even China is positive. India, meanwhile, is lagging. It's largely something that we have seen, that AI-backed stocks or something, pick and shovel stocks tied to chips and other parts of semiconductor chain are doing pretty well. That's the same thing, even on the earnings estimate side. So keep this in mind, like prices are set largely by investors. So investors are pretty much exhibiting similar trends or continuation of 2025 with AI markets leading, China, continuing its rebound, probably, going with the earnings expansion more this time than valuations. And along the similar lines, we are also seeing analysts raising their earnings estimates. Korea and, again, Taiwan are doing pretty well. They are leading the pack with, I think, 6 to 10% increase in their 12-month forward earnings estimates, followed by a couple of other markets and even China, going ahead of, India and Japan. So, that's largely the outlook, pretty much how it happened. It's gonna give similar returns. There were expectations that India might outperform or might see a rebound, but those are getting dashed given the macro problems and earnings slowdown that we are seeing in the large cap space there.
So when we're talking about technology that's focused on AI, does it come down to the chip makers primarily? Is that the essential focus?
Absolutely. I mean, for Asia, chip makers, are key, and for markets like Korea and Taiwan, that's primarily the bet. However, in case of China, you're seeing a lot of market cap actually getting created because of AI related enablement of businesses. A lot of businesses trying to get AI to boost their earnings operationally. So it's not just about chips or the pick and shovel of the sector. It is moving in the direction in case of China as it has moved in the US. So there is a lot more confidence. You may have seen how many AI related listings have happened in Hong Kong and mainland this time, and almost each one of them have seen a pretty good reception, and that's a trend that is expected to continue. If you look, Taiwan and Korea, there are some calls out there. Some strategists are wondering that if it's getting too crowded and maybe there should be some rotation to less owned sectors, but they still very much want to stay in the AI theme. So even if there is a cool off on chips, the money would rotate to names in China and elsewhere where AI is actually starting to aid bottom lines.
So I mentioned the fact that the CPI report in the States was a little cooler than forecast. And money markets are continuing to project the next Fed rate cut in mid-2026. And I think right now the swaps market is still holding with the idea that we're going to get a total of 225 basis point rate cuts. It seems like the market has already had the ability or the opportunity to discount those moves from the Fed, and that's being reflected in the dollar at the moment. Or am I wrong? And could we begin to anticipate a little bit more dollar weakness this year?
Yeah, I mean, markets are definitely pricing what swaps and, other cross assets are reflecting. But, one thing that's not been discounted to a great extent right now is, President Donald Trump's penchant for rate cuts. Markets are pricing consensus, what the expectations are right now. It, from what we have reported and what we have talked about after CPI data, it looks like, given his campaign against Jerome Powell, and his penchant for lower interest rates, there can be a lot more rate cuts than what swaps and futures are reflecting right now. So that's something that will continue to weigh on dollar, and that because it weighs on dollar, it feeds into other risk assets, because barring a few assets, almost every other asset has a negative correlation to US dollar, and therefore both on the US equities, EM equities, we're gonna see a move higher. So and look, even if look at the backdrop, these rate cuts and this scenario of liquidity improving across markets because of rate cuts and fiscal spending, that pretty much remains the case for this year too. And markets have sort of started looking ahead and ignoring geopolitical risk. That remains the setup for this time around as well. Just that there may be more rate cuts given what Trump wants Fed to do, and he is in that position where he can influence the policy a lot more. Mm-hmm. So let's see how it plays out.
So I'm curious as to how what we're seeing coming from the Trump administration, the dynamics that are at play right now, how that's impacting the thinking on asset allocation in parts of the Asia Pacific market.
Yeah, no, we've started reporting a lot more on that, and it goes back to the point that some of our reporters made last year, where there were talks about peak US exposure. I think that's sort of coming back, given Trump has started focusing a lot more on intervention in a variety of subjects, and I mean it's a different sort of globalization, but it hurts US. US being a US position as a bellwether for global economy. So, I mean, given what the FX swap that Trump administration carried out in Argentina, given what they have done in Venezuela, they are focusing a lot more on their hemisphere, which means the rest of the world, like Europe may have influential players like Russia, Asia has China and India. So it's again becoming a multipolar world, and therefore, it just makes sense for long-term money to start looking at other avenues where there is better growth prospect. Of course, Mac 7 or, companies which are like Microsoft, which are generating so much more money, and where, people's lives are revolving around those companies, they remain unscathed. But a lot more money, would start looking at exposure outside the U.S. And in terms of major economies, major fast-growing economies, and with similar kind of capability as the U.S., China come to mind. So the appeal of owning Chinese assets, or stocks, yuan, and others, that increases a lot more. So this interventionist sort of moves by the US, this will marginally hurt at least the non-Max 7 part of US economy.
We're seeing a lot of interest in precious metals lately, and I'm looking at a rally right now in both silver and platinum today. Would you say that this is a trade that is based on momentum, or is it more related to this idea that we're looking for opportunities to find havens? Is that really what this precious metals trade is about?
Oh, no, absolutely. It's not momentum at all. I mean, if you have been following the last year, the advances that these precious metals made last year, it's largely happened, not in void, but it has happened in context of Russia's move in Ukraine and what U.S. did in terms of their exposure to U.S. treasuries. So suddenly, in central banks' reserves, U.S. treasury is not a guarantee, as, said by one of the researchers gave call recently in a note, and that made a lot of central banks actually move towards gold to diversify their reserves, and then this move started getting reflected in silver as well, because in terms of precious metals, one thing is there that you can hold a lot of that. The storage cost is not as much, and a very little exposure means big amounts in dollar terms. So that started getting reflected in silver, and now that's getting reflected in platinum as well. The way things are moving, it's a bit of a hedge. It's a bit of a necessity and a natural consequence of what we are seeing in the world. You need some levers where this geopolitical pressure, what Trump is doing, gets reflected rightly, and gold, silver, these kind of commodities go in that direction. After central banks, there is a lot more exposure by portfolio investors as well. In terms of portfolio construction, gold was supposed to be a single-digit exposure. I don't think a lot of investors are feeling that way. There are many out there who have it in double-digit terms, especially on the multi-asset side. And last year, Doug, gold was up as much as KOSPI, which was the best performing equity market. So, it has become an asset, a macro asset class, not a hedge, but a macro asset class with absolute returns, in offing. So this is expected to continue, and now, given it has run up so much more, and the relative valuations versus other commodities and other markets have gone for a toss. There is a case building increasingly that the next thing that investors would look to diversify or own, in context of whatever is happening in the world, might be oil and other commodities. We are looking to do more reporting there.
Abhishek, we'll leave it there. Thanks so very much. Bloomberg's Abhishek Vishnoi joining from Singapore here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. We go next to Japan, where Prime Minister Sanae Takaichi is reportedly planning to call for a snap election. We're seeing a rally in Japanese equities. Yields on JGBs are higher, and the yen is weakening deeper into the zone where intervention becomes a risk. That's where we begin our conversation with Zuhair Khan. He is senior portfolio manager at UBP. Khan spoke with Bloomberg TV host Paul Allen and Avril.
So, Zuhair, great to see you. And looking at what the Japanese stock market outlook is, it looks quite bright. I mean, the pro-growth expectations from Takaichi. What is your sense of whether we have more upside on Japanese stocks?
So I think the Japanese market overall is fairly valued. If you exclude one thing, which is continued significant corporate governance reform, excluding that, it's fully valued. But there are a lot of Japanese companies which have not yet benefited from corporate governance reform. I mean, 60% of Japanese companies still have close to 20% of their balance sheet in cash. A large majority of Japanese companies still have loss-making, unprofitable business segments. And then you have a significant need for consolidation in the Japanese market. There are too many companies in the same industry, each of which are subscale and not very profitable. So consolidation would tremendously benefit the market. So if those things continue to happen, there is upside without, sort of, let's say, an acceleration of those things, because part of it is priced in. I think the market is fairly valued.
Okay, what about
one thing I would like to highlight is that. Sorry, I was just going to say one last comment, which is that relative to global markets, the Japanese market, even though I think on an absolute level it's fairly valued, on a relative level it remains very attractive among other major global markets. Sorry, you had a question on yen.
How much are you expecting foreign investors to then, turn their attention to Japan? And given the yen volatility, does that figure into the attractiveness of the market?
So I think given how weak the yen is currently, I think for foreign investors, that's an added attractiveness of the Japanese market, because I think the yen is undervalued and over time it should recover. The pace and timing of that is difficult. It'll depend more on Fed loosening policy rather than the BOJ tightening, because the BOJ is going to tighten at a very slow pace. And then it's also going to depend a bit on sentiment. So a lot of Japanese continue to invest overseas, very significant amounts to the new investment savings account, NISA. A lot of that money is going overseas. Japanese companies, because the yen has continued to remain weak, have not been repatriating their profits back into Japan. So if you start to see a strengthening, I think those factors may start to reverse and then add to the trend of yen strengthening. But I think it'll depend more on Fed moves rather than BOJ moves in the near term.
So we've got this environment of very weak yen, closing in on 160, weakest since July 2024. And at the same time, we've got yields climbing as well. Now, we've got some commentary from Carlyle saying, look, this is a good sign. The economy's exiting deflation. But is that really a sign of economic health when you look at that sort of trend? Any reason to be concerned?
No, I completely agree with them. If you look at the 10-year Japanese inflation index bonds, the real return on those is only 0.22% currently. It's less than 0.3%. If you compare that, for example, to the German interest rates, the real inflation protected interest rates, it's about 1%, just under 1%. If you look at the US, UK, France, it's between 1.5% to 2%. So Japanese real interest rates, inflation protected, remain very low. So I don't think that's an issue. And in fact, Japanese inflation is actually helping the government currently on the debt to GDP ratio, right? So nominal GDP is growing faster than the debt is growing. And so the nominal debt to GDP is actually declining. And I think that remains well under control. I think what happened until this past year and the later half of last year was that as global inflation was declining, people expected that Japan's inflation, which was running at around 3%, would decline and Japan would go back towards zero inflation. And hence the Japanese longer-term bond yields were not going up. But what they've seen is that Japanese inflation has remained quite sticky and strong despite global inflation declining. And so that's given people confidence that Japan is truly out of deflation. And that's why the longer-term bond yields in Japan have been going up.
Do you see any upside risk to inflation from the yen pushing up prices of imports?
Yes. And this is a big political problem for Takaichi. I mean, this is why her predecessor, Ishiba, basically had to step down, was because people were unhappy with inflation and the cost of living in Japan. So it's something that she needs to tackle. She has other political issues as well, but there's an opportunity. There's recently, rumors about she may call for an early election. That may be a positive for her, but there are, of course, risks whenever you go into an election.
Zuhair, talk to us about the sectors that you are perhaps a bit more cautious on given the valuations, tech, financials, for example.
Yeah, so I think the rising interest rates are more than priced into financials, especially insurance companies and banks and regional banks. Not as much the mega bank. The mega banks are maybe a bit better, but regional banks, insurance companies, I think rising interest rates are more than priced in. A lot of, let's say, inbound thematic names like restaurants, department stores, I think are overvalued. The tech names, I think, are overvalued. Defense-related names has been a big thematic this past year in Japan. That's overvalued. There's been a bit of an AI mania in Japan, and I'll give you one sort of example of an AI mania. So until earlier, let's say middle of last year, late last year, Japanese factory automation names were considered sort of a bit negatively because there wasn't a strong rebound in demand from China because of the involution policies of the Chinese government to reduce capacity. But then suddenly it became, robotics is the next AI, factory automation is the next AI name, and those just bounced up like crazy. And then what you see is as they're reporting earnings and outlook, there's no improvement. It was just that, robotics is the next AI and the valuation ran up. So there are those sort of thematic sectors that we need to be quite cautious about.
Do you see that caution also part of the function of the way in which South Korean markets, we've been seeing that robotics theme also playing out there. Does that sap some of the investor appetite at a time when memory prices are trending at these levels? That seems to be supportive more of South Korea, big chip makers, rather than the other electronics makers across the region.
Yeah, so I think, this theme has become rather, when we look at, let's say, even the more bullish forecast, for example, for many of the Japanese component makers or companies in the semiconductor supply chain, and we look at the more bullish forecast, and then we price those in, using a discounted cash flow model, we still can't explain current valuation, right? So even using the most bullish forecast. So I think there's a bit too much priced into the market currently.
That was Zuhair Khan, Senior Portfolio Manager at UBP, speaking with Bloomberg TV host Paul Allen and Avril Hong. And we're bringing it to you here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.